This is sort of, I guess, the last quarter that we're going to have before the new CEO comes in. And I'm wondering that when you sort of look long term and the outlook for Wells Fargo, and you put that against the backdrop of what happened in the most recent quarter, are you looking more towards, I guess, an acceleration in some of those numbers that kind of disappointed investors this quarter around?
Well, the numbers as they turn out in any quarter reflect the accounting realities of the quarter, so there's no acceleration. I do think, though, that there are things from today's report that do speak to the future and set up what Charlie will be stepping into as the new CEO of Wells Fargo. And we saw it in terms of loan and deposit growth, which are both good signs, and loan growth came from a variety of places, mostly, or I should say more on the consumer side. You were just talking before about what's happening in consumer lending more broadly, but mortgages, autos, credit cards, all up nicely in the quarter and year over year. So he's stepping into that, stepping into a company that's got a brisk mortgage production business, not just on the balance sheet, but we're a big originator for sale, and both the pipeline and the gain on sale in that area are at relative highs over recent periods. We have work to do on the cost side. You mentioned that as well in a different context, and he knows that he's stepping into that. But the business is very well positioned across all the areas where we compete to do very well. So that are the advantages of the company that he's stepping to the helm to run.
Well, on the cost side, specifically the legal cost side, taking a $1.6 billion legal charge this quarter. Obviously, this has happened multiple times in the last couple of years. How far along are you on the cost side in cleaning that up and putting that behind you?
Yeah, I think quite far. We report every quarter in our 10Q what we imagine to be the reasonably possible legal expenses that we might incur. We'll be filing 10Q in a couple weeks, and that'll have the latest reflection of what those estimates are. But my observation is that the charge that we took in this quarter, which relates to items that have been percolating for the last couple of years, really does begin to move that through.
Talk to us a little bit about net interest income and how that's been pulling down once again. You already lowered your expectations, but how difficult an environment is it right now as we head what seemingly is into a period of, well, certainly easing rather than tightening when it comes to the Federal Reserve?
Sure. Well, so the story starts with what advantages deposit-heavy banks had on the way up with interest rates, and a variety of us have very low-cost deposit bases, and that was a real advantage as assets priced up as the Fed moved Fed funds up, as LIBOR priced up over the last couple of years, and now we're seeing the other side of that, where assets are pricing down. But deposit costs don't price down as quickly. In some cases, they didn't move up that much at all, and in other cases, you can get some of it back. But it's unlikely that as you roll forward over the next several quarters, that we'll get the same kind of recovery in cost saving on the deposit side. So we had given guidance for this year at about down 6%, 18 versus 19, or 2019 compared to 2018. And this morning on our call, we talked about what next year looks like, which I think, based on the performance in our stock today, was a little bit better than what some folks might have imagined, given how hard the bond market has been rallying in the third quarter, and now that the Fed has begun to move at the front end. So, people were expecting that. Investors, I think, were expecting the worst, and at least as I've seen it so far, it looks manageable. It's a cost, it's a headwind without a doubt, but it seems to be priced in.
So when you look at sort of the mortgage side of the business, John, we did see some pretty good numbers with regards to new mortgages, but of course there are also quite a few refinancings, and we've seen some data out from the Mortgage Bankers Association kind of showing that imbalance between the growth that you're going to see, that the industry is going to see in mortgage originations versus what they're going to see in refinancing. How is Wells Fargo balancing that?
Sure. So we had about $58 billion worth of mortgage production during the quarter. About 40% of that was refinancing and 60% was purchase related, so less than half. Some of the refinancings are refinancings of mortgages held on other banks' books onto ours. Similarly, we lose some refinancings that way. And some refinancings are our own customers who are refinancing into a lower rate. So like a lot of loan asset classes, the advantage to the customer works against us from a yield on earning assets perspective. But for for, call it half of our mortgage production, we're selling into either into Ginnie Mae securities or Fannie and Freddie securities, where it isn't so much of an earning asset issue for us, but there's a gain on that sale, and those gains have actually been expanding over the course of the last quarter, because these higher volumes are really completely consuming capacity in the industry, and pricing reflects that. So it's a better time to be in that business. So some on the balance sheet, some sold through and generating a gain, and lower rates are absolutely stimulating both refi activity and affordability activity on the purchase side of the market.